Key theories that explain and influence financial performance in business include agency theory, stewardship theory, stakeholder theory, trade-off theory, and pecking order theory. These theories provide conceptual frameworks for understanding how firms make financial decisions, manage internal and external relationships, and ultimately achieve performance goals. Agency theory. Core concept. This theory, developed by Jensen and Meckling, 1976, focuses on the relationship between principals, owners, shareholders, and agents, managers. It assumes that both parties are self-interested, which can lead to conflicts of interest, agency problems, when managers pursue their own goals at the expense of shareholder wealth maximization. Impact on performance. Agency costs, monitoring, bonding, and residual losses are incurred to align manager interests with owners' interests. Effective corporate governance mechanisms, such as independent boards and performance-based incentives, are needed to mitigate these conflicts and enhance firm performance. Stewardship theory. Core concept. A contrasting view to agency theory, stewardship theory assumes that managers are good stewards of the company and are motivated by intrinsic rewards like job satisfaction and a desire to achieve organizational goals. They are expected to act in the best interests of the firm and its owners. Impact on performance. This theory suggests that an organizational structure based on trust and autonomy, rather than strict control, can lead to superior performance because managers are empowered to make efficient decisions without unnecessary bureaucracy. Stakeholder theory. Core concept. Proposed by Freeman, 1984, this theory broadens the firm's responsibilities beyond just shareholders to a wider range of stakeholders, including employees, customers, suppliers, and the community. It argues that a company's performance cannot be measured solely by shareholder returns. Impact on performance. Firms that balance the interests of all stakeholders may build a better reputation, reduce risks, e.g., legal or reputational, and achieve long-term financial success and sustainability. Capital structure theories, trade-off and pecking order. These theories explain how firms choose their mix of debt and equity financing, which impacts financial performance. Trade-off theory. This theory posits that firms balance the tax benefits of debt financing against the costs of financial distress, like bankruptcy or agency costs, to achieve an optimal capital structure. Pecking order theory. This theory suggests a hierarchy of financing preferences due to information asymmetry between managers and outside investors. Firms prefer to use internal funds first, then debt, and finally, new equity as a last resort to avoid sending negative signals to the market.